Hi, Professor J, and welcome to Adjusting Entries Part 2, where we talk about depreciation and contra accounts. So, the last and probably one of the most important adjusting entries that you're going to make is on long-term assets. Any kind of asset that has a life of over a year has to be depreciated in general. So let's say under assets we have a building with a 50-year life. Well, here's the thing. The building, I'm going to pick easy numbers. The building is worth $50 million also, and it has a 50-year life. But there's a little annoying rule called historical value that whatever you put on the books has to be recorded at historical value. Well, but we're also supposed to slowly expense it over its life. It has a 50-year life. Well, using what we call straight line depreciation. There's different kinds of depreciation, but that's for another week. We're going to use straight line. Basically, if it's a $50 million building, we divide by its 50 years of useful life, and every year we have to depreciate it by $1 million. Depreciation is basically just slowly using it up. Now, yes, the building might be worth way more than $50 million. Maybe the value goes up to $250 million because it's in a great part of town and it's a historical building, whatever. Doesn't matter in accounting. We don't care what the market value is or what people would buy and sell for it. We'll get into that later, how to handle that. That only comes into play if you actually sell it. But for what gets recorded on the books, you keep it at historical value. Year one, it'll look like I have a $50 million building. But year two, after I expense it $1 million, ruh-roh, it's going to look like I sold the first building and bought a building worth $49 million. And the year after that, it'll look like I bought a building worth $48 million. So we don't do it like that. We have to show that we still have the $50 million building on the books. And we have to show depreciation or how we expense it separate from that. So here's how we do it. It's called a contra asset account. And it is tied to the building account. So it will say, tied right to it, accumulated depreciation dash building. Every long-term asset will have an accumulated depreciation dash whatever. So that's why you say dash whatever. It could be dash car, dash truck, dash factory equipment, anything with a life longer than a year. Here's the thing. For depreciation, it's as if we are not allowed to put anything in that side of the building account. So what we do is this right here functions as that side. And we put it right here. Voila. I just credited an account in assets, didn't I? The accumulated depreciation account. I need to expense it. Depreciation is an expense where it's like air. Nobody saw anything happen, but the building got older, so we expense it. So we would put depreciation expense, and you know expenses fall under equity accounts, and they are the exception. The exception is expenses. They get debited instead of everything else that gets credited on this side to increase. We increase it here. So voila, there's our entry. So the next year, this will say 50 million. Accumulated depreciation will still have that 1 million in it. We add another million. But at the end of the year, if you read the part about closing entries, depreciation expense gets zeroed out at the end of every year. When we make this entry, we'll make another 1 million entry there. It starts over every year. Income statement accounts, revenues and expenses start over every year. They get zeroed out to retained earnings. You need to read about closing entries. But accumulated depreciation shows all of them. So that these two added together are called net book value. NBV, or just book value. So the book value of the building after 2 years is $48 million. And people looking at the balance sheet will see on the balance sheet, it'll say assets. And underneath it, it'll say building. And then it'll show 50 million. And then underneath it, it will say less, with a little colon there, accumulated depreciation, 2 million, and then underneath, 48 million. That's how it's done right there on the depreciation account. Let's do one more, just so you kind of get the idea. Let's now say that we have a company car. So we have a car account, and the car is worth $25,000 book value when we buy it. Well, it has a 5-year life, so accumulated depreciation car, the contra asset account, same thing. After the first year, 25,000 divided by a 5-year life means $5,000 a year will get depreciated, and under depreciation expense, we can put the $5,000 there as well. Usually we do lump all our depreciation together, whether it's on buildings or cars or trucks. We just call it one big fat depreciation expense and throw them all over there. So, now you know what net book value means. Now you know what a contra asset account is. It's that accumulated depreciation account or accounts. And you know how to do the adjusting entry for depreciation, where you debit depreciation expense and you credit accumulated depreciation. Hope this helped. Talk to you in the next video.